Hi everyone, thanks for joining our McCloud Remedy webinar. We've got Tony Goldstone with us, Dan from our financial planning team, and I'm Kieran Hancock. We'll be talking about lots of things. We're just waiting for the numbers to tick up a bit. We've got a few just joining, and we're just past 7 o'clock, so we'll just wait a couple of minutes just to make sure we've captured everything. So there might just be a bit of a pause, a bit of a silence, just for a minute or so whilst we wait for those, and then we'll move on and just explain to everyone what we're doing here tonight and what we're going to cover for you all, if that's okay.
So just while we're waiting for others to join, at the bottom of the screen, you'll see there's a Q&A box. And if you click on that, if you've got any questions that you want to put to the panel, if you type your questions in, then we'll try and come to those at the end as well.
Yeah, thanks, Tony. And also, for those of you who have joined, we're obviously recording this, and we'll share a copy of the recording afterwards. There'll also be some more information as well, so a couple of links to various different things that we want to share afterwards, just to make sure that we've got, that you've got the relevant information to hand. We're going to cover lots of different things, and we just want to make sure that you go to the right places. The numbers have slowed down slightly, so I think we'll make a start if that's okay. So for anyone who's just joined in the last couple of minutes, welcome to our McCloud webinar. My name's Kieran Hancock. I'm a director in our healthcare team. We've got Tony Goldstone with us. I'm very lucky to have Tony speaking with us today. And we've got Dan from our financial planning team who will just cover a few bits at the end of the session. So if we can go to the next slide, please, we'll just introduce what we're going to cover today. So quite a fully packed schedule that we've got today. So we'll try and stick to about an hour if we can. We've got time at the end for a bit of a Q&A, and if we end up going over an hour, if there's questions coming in, hopefully you'll understand and be happy to wait around and for us to answer those questions. So essentially what we're going to do today is it's really just about McCloud. You will have heard of the terms RPSS, Remedial Pension Savings Statement. We're going to cover what those are, what you need to do with it, and also what we can do to help you. So we've developed a service alongside Tony, using his expertise and some of his tools that he's created to provide a specialised service to our clients and anyone who's affected by McCloud Remedy. So as we've said, Q&A section at the bottom. If you click in there, you can ask away, ask your questions. We'll try to answer those as we go through. And if not, if there's any that affect everyone or we think is relevant to everyone, then we'll cover those off at the end. So feel free to get involved and we'll do our best to answer where we can. So if we can just move on to the next one, please. So for those of you who don't know us and are joining today, we've got we're Forvis Mazars, so we're a large top 10 UK accounting firm, and we're part of a global network of experts covering lots of different countries around the world. But we're also a specialist medical accountants, and we're a leading member of AISMA. So for anyone who isn't aware of AISMA, it's the Association of Independent Specialist Medical Accountants. And we're proud to be members of those, and it's really interesting to be part of that network. We're a team of about 50 in our specialist healthcare team, covering largely Manchester and Scotland. Those are our main bases, but obviously we cover the whole country, from bottom to top effectively. And we act for a large number of GP practices. They're sort of part of the core of what we do, but we also act for 2,000 or so medical professionals, and that will include, consultants, locums, salary GPs, and anyone in between those. And as I've just said, part of our key focus is really to support the medical profession, and the support and resources that we've got have allowed us to partner with Tony and create this sort of bespoke service, which is really beneficial, for anyone who's affected by McCloud, and we'll cover a bit more of that later. As I've said, I'm a director in our healthcare team, so I'll be sharing sort of the stage alongside Tony today. I've been in the medical accounting sector for over 10 years. And proud to be a board member of AISMA, and something that we've recently set up is a next gen committee, which essentially is looking at succession plans for AISMA and the future training needs that ASMA members may have. So I'll just hand over to Tony now. So I'll let Tony introduce himself, and then he's got a reasonable number of slides to go through on some key things in terms of pension taxes, and then he'll hand back to me and we'll run through our service. And as I say, we'll work through and go from there. So over to you, Tony, if that's okay.
Hi, thanks very much, Kieran. So I'm Tony Goldstone. I'm a radiologist up in East Yorkshire, and prior to 8 or 9 years ago, knew nothing at all about pension tax until the brown envelopes started landing on my mat, and then got very interested when I realised that it could literally destroy the profession if something wasn't done about it. So lots of you may have heard of me through various bits that I've done with the BMA. I'm currently deputy chair of the BMA Pensions Committee, and I was the advisor to the BMA, the National Clinical Advisor on Pay and Pensions, for 6 years, and I also still sit on TAG, which is a part of the NHS Pensions Board, and I've been working with government for the last 6 or 7 years on this whole complete car crash that is pension taxation. So if we do next slide, please. So rather than just kind of dive in on what's actually on your RPSS, I just wanted to kind of give you a quick overview of what pension tax actually is, because I think it's really important to have kind of a basic understanding of it, to kind of understand what the numbers are, and also understand the value of your pension. So at its most fundamental level, what is a pension is one question, and a pension basically is deferred earnings. So we obviously get remuneration from the NHS as part of our jobs, whether you're a consultant or a GP or a SAS doctor, for example. But part of our remuneration package, and a really important part of our remuneration package, is a pension, and that pension is deferred income. And it's important to realise there's a big difference between the kind of pension that we have, which is a so-called defined benefit pension, and what is more common in the private sector, which is a defined contribution pension. So I'll start off with what we don't have, which is the DC bit. So a DC pension in the private sector, what people typically have, you make contributions to, and you get tax relief on those, and your employer makes contributions to. They go into a pot, an actual pot of money, and that pot can be invested, for example, in the stock market. And then depending what happens to that pot, when you come to retirement, you can either draw down and take some of that money out tax-free, or as a pension, which is subject to income tax, or you can buy an income from that pot, or an annuity. So there's obviously a degree of risk with that, because no one knows what's going to happen to the stock market, for example. And the type of pension that we have is very different. It's called a defined benefits pension, and it's called defined benefit because rather than it be based on a pot that's kind of put at risk to the stock market, we get a pension promise from the government. And that pension promise, so just if we go back, sorry, Jordan, that pension promise is based on basically our service and what our income was during that time, and it works differently slightly for GPs as it does for consultants. So this initial slide, I'm going to talk initially about the lifetime allowance, and some of you may be asking why we're talking about the lifetime allowance when it was essentially scrapped in the March 2023 budget. And I think it's important that people still have a concept of the lifetime allowance, not least because we know that when it was scrapped, Labour immediately said that they were going to reintroduce it, and none of us know what's around the corner and what's going to happen next year. But because of the different way that our pension works with this defined benefit, rather than having a pot, the government needed some way of assessing the value of our pension. And they did that using a formula. And basically the formula was 20 times pension plus your lump sum for the 1995 pension. And at its peak, that pot could be 1.8 million. And that meant that you could save in a tax efficient way up to a pot worth 1.8 million. You could still save above that. But if you exceeded that, and that was typically with a pension of around 46,000, then that would be taxed quite heavily. And that tax is 25% if it applies to your pension. And as I said before, your pension is then subject to income tax, or 55% if it's paid as a lump sum. And it sounds like there's a big difference between the two, but actually they're broadly equivalent. It's just that the pension is subject to income tax after the event. So this caused a problem because lots of doctors, particularly GPs and consultants, were typically reaching the new lowered LTA of around 1 million in their mid-50s. And of course, that was then a potent driver for them to stop saving into their pension and to look at early retirement or reducing their hours. And so we lobbied furiously with the BMA and others. And fortunately, the LTA was scrapped. Initially, the LTA charge from 2023 and then fully scrapped from 2024. There are still some remnants of the LTA that exist, however. So, for example, the amount of tax-free cash you can take, i.e. tax-free lump sum, is still fixed at 25% of the old limit. And so that's an important number. So next slide, please. So we've talked about the total pot you can fill, and so that analogy of a jug. So we've got to basically fill the jug to ideally up to a litre or 1.07 litres, but we've got to do it in a way that's steady. And because the government also had this concept called the annual allowance, and the annual allowance wasn't introduced for the likes of you and me, public sector workers. It was meant to be to stop tax avoidance in the city. So under the old scheme, high earners in the city could be paid £1 million and then also put £1 million into their pension, and that was deemed far too generous. But of course, the city boys never ended up getting taxed at all because they just changed their remuneration package and shifted it to income. And they never ended up paying the AA, but in fact, it was us that ended up paying the AA. And again, in the same way that there was a complex formula to try and work out how much your pension had grown for the LTA, it's the same for the annual allowance. And they do that by looking at your pension each year and comparing it to what the inflation lift on your pension was from the year before. And if it goes up above inflation, how much it goes up by is then increased by 16 or 19 times, depending on the scheme. And if that exceeded the allowance, you are then subject to taxation. And initially, that was very generous at £255,000. And when it was £255,000 back in 11-12, no one was affected effectively. But then that was reduced to 50 and then to £40,000. And then, of course, one of the most ill thought out pieces of tax legislation ever introduced was the tapered annual allowance in 16-17, which then introduced some new concepts called threshold income, which is best thought of simply as taxable income, and also adjusted income, which is basically your taxable income plus the amount of deemed growth in that year. And if that exceeded the so-called adjusted income limit, then that tapered growth reduces really drastically. And so at its minimum, it could have gone down to £4,000. And obviously, if you're trying to fill a 1 litre pot with 4 mils a year, it's just absolutely impossible to do that in a tax efficient way. That's been relaxed slightly, so the minimum tapering is increased to £10,000, but the taper was a really big problem. So next slide, please. So when I speak to people about the taper, lots of people don't appreciate that it's actually changed quite a lot. But it's still definitely a problem, albeit less of a problem than it was previously. So if we look at this chart, on the bottom axis, the x-axis, is adjusted income. And remember, that's not income as such, that's your taxable income plus your deemed growth. So originally, everyone was at £40,000 and it didn't change. If we look at the orange line, we can see how the taper changed in the 2020 budget. So everything moved across from the red line by about £90,000, which meant that your adjusted income could be £90,000 higher before people were tapered, and that was definitely welcome. But the sting in the tail to that was that minimum tapering increased to £4,000 instead of the previous limit of £10,000. And now if we look at the yellow line, that's where we are after the 2023 budget. So the general, sorry, just go back at one, Jordan. If we go to the yellow line, the general annual allowance has increased to £60,000, which is very welcome. And now you can have a much higher adjusted income before you're fully tapered. Next slide, thanks. So the reason we're all here is because of McCloud, and McCloud arises because of this report, the Hutton report. So basically, around 2010, the coalition government decided that our final salary schemes were becoming too expensive for the taxpayer after the financial crash. And that was mediated largely by not only the economic situation that the government faced, but also by the fact that our longevity had changed enormously since the schemes were initially set up. So people were spending a much higher proportion of their life in retirement than they were working, and that meant the cost of the scheme was becoming too expensive. The government wanted to get rid of defined benefit pensions altogether, and move it over to something a little bit closer to what the private sector had. But Lord Hutton, who was a very smart chap, felt that that was probably a step too far for the public sector. And so what was agreed was that we moved over to a care scheme, and that's career average revalued earnings. And of course, GPs are very familiar with care pensions because their 1995 scheme was also essentially a care scheme rather than final salary. And crucially, because they have this issue with longevity changing, rather than it being a fixed pension age of age 60, it moved to state pension age. So they knew that it didn't need revisiting every time there was a significant change in longevity. And because of that, and something called the cost caps, I'm not going to go into, but it was basically a guarantee to taxpayers and also to the public sector worker that the new system, this new 2015 pension scheme, was going to be fair, and hence it could come with a 25-year guarantee that they didn't need to tinker with it. Now, crucially, in his report, Lord Hutton warned the government to not give protection to older members of the scheme because, firstly, it wouldn't be necessary because they had more 1995 service anyway, so they didn't need protecting. But secondarily, that age discrimination law would meant that you can't do it in practice. And of course, he was right. Governments ignored Lord Hutton. They pressed on and they gave protection to those within 10 years or so of the change. And because of that, a very bright judge called McCloud sued the government. And after lots of appeals, they won, and it was felt to be unfair. And the solution to that is why we're all here. That's the McCloud Remedy. So next page, please. So McCloud is pretty complicated, and this is McCloud on a page. So I'm going to kind of split this into two bits. So the top of the page is kind of what the ultimate McCloud remedy is. So if we look at that box on the left-hand side, everyone before the 2015 scheme that's eligible for McCloud keeps their service in the legacy scheme. Everybody after 2022 is in the new reformed scheme, and McCloud is the bit about the middle, that 7-year period from 2015 to 2022. And basically at retirement, you get to make the decision whether or not you want that 7-year period in the old scheme or in the new scheme. So that's what happens at retirement, but they had to do something now. And the bit that they had to do now was immediately remove the discrimination. So they removed the discrimination by rolling everybody back for that 7-year period into that old scheme before they got to make that decision. And that's what this red box is here. But there are big tax implications to that, because as I just discussed with that kind of complex graph with the taper, there's been a ton of changes in that 7-year period to pension taxation. So in 15-16, there was no tapering. We then had the initial very brutal taper that kicked in at 110k, and incidentally, 110k was mean taxable earnings for both GPs and consultants when that was introduced. So roughly half of both of those groups were potentially affected by that. We then had in England and Wales for 1920 a compensation scheme, and then we had the new limits that were £90,000 higher at the end of the bit. We further complicate matters by this concept of having in scope and out of scope years. So what does that mean? So when you do your tax return, if you want to make an alteration to your tax return now or in any of the previous 4 years, you can do so because that's so-called in scope. But you can't make amendments to things that are more than 4 years old, and that's out of scope. So there's also differences in how the compensation operates between in scope and out of scope years. The bottom line is that for the in scope years, if you've got more tax to pay through whatever changes arise, you've got to pay it. The exception being in the 1920 tax year, if you're a clinician, you can still use the compensation scheme. For the out of scope years, if you get a refund, you can still get that refund as compensation. But if there's more tax to pay, there's nothing the government can do because it's out of scope and there's no mechanism for them to claw back that money for the out of scope years. So we've got 7 tax years versus the 1 year that your accountant would normally be putting in for on the 31st of Jan. Add into that the fact that they delayed 22-23, and then you've got 8 tax years to deal with. They then very stupidly decided to make it all coterminous with the tax deadline for the 23-24 tax year, which was the 31st of Jan deadline that's just gone. So you've now got 9 tax years to submit for at the same time. And then, of course, you need some pre-remedy data to be able to work out your carry forward positions. That adds another 5 years. So we've got 14 years of tax data to process. And of course, that means that it's extremely complex and very easy to get wrong. So next slide, please. So who's affected? Well, there's about 1 million members of the NHS pension scheme who are affected by McCloud in total. Obviously, this taxation issue only affects higher earners. The government keep on changing their mind over how many people are affected or not, and I suspect they still don't know the correct number, not least because of the mess that GP pension records in particular are in, particularly in England because of the PCSE situation. But the last time they answered the parliamentary question on it, they said that around 137,000 need RPSSs, and there's still well over 30,000 outstanding, and GPs are massively overrepresented in that number. It's fair to say that every time an MP or a minister asks this question, they get a different answer. So we don't really know how many people are involved. Next slide, please. Next slide, please. So what is an RPSS? So in a second, I'm going to take you onto my own RPSS and talk you through the numbers and how you can address it. But essentially, the RPSS is a bit like a traditional pension savings statement, but it includes both your pre-rollback and your post-rollback growth. And using all of that data and some supplementary data, so for example, scheme pays loans, you can work out whether or not you need to use the full NHS digital service and whether or not you've got tax to pay or a tax refund. So next slide, please. So this graphic, it kind of illustrates the NHS digital service. So HMRC have designed this service to help people navigate this incredibly complex mess. And to do that, they've developed a website which takes you through over 200 pages to determine whether or not you've got a charge to pay or you've got a refund. But not everybody needs to do the full service. And government were worried that they would have to compensate everybody to have to use the full service. So they introduced a process called triage to try and weed out people that they didn't feel needed to use the full service. I'm going to try and share my screen if the wonders of modern technology work. I don't know whether Jordan needs to stop sharing. or click, yeah, that multiple things. Oh, there we are. Great. So hopefully you can see my screen. If you follow the QR on there, you can print out a blank one of these triage forms. And then it basically takes you through these 6 questions. So I'll talk you through the 6 questions, then I'll just talk you through my RPSS. And so they're basically trying to work out anybody who might be due a refund or who might need to pay more tax. And if you fail triage, you then need to go on and do the full 200 pages of the HMRC calculator, but you can fail on any of them. Okay, so question one is pretty straightforward: is have you ever paid an AA charge between 15/16 and 21/22? Now on the RPSS, on the last page, the summary page, there is a list of scheme pays charges, so you can see straight away if you've paid via scheme pays. And so if you have your triage fail, that means you need to use the full tool. And crucially, those people that do need to use the full tool, the full 200 pages, can access compensation of £1,000, including VAT, to get an accountant to do this for them. So that's question one. Now, obviously, the form in England and Wales has scheme pays, and also in Northern Ireland. Despite my requests, the SPPA form in Scotland doesn't show scheme pays, but people should hopefully know and or have record that they did pay a scheme pays charge during that year. But also some people obviously will have paid via self-assessment, so you will need to know whether or not you have paid tax yourself to answer that first question. So question two asks, have your contributions changed? And that is alluding to GPs who are subject to annualisation. So if you're a locum GP and subject to annualisation, most GPs, of course, will know that. And then if you are, then you're asked 2 supplementary questions about whether or not you are close to the tapering limit. So if your net income is above 100k, before the limit went up from 110 to the high limit, and for the later years of the remedy, was your income ever above 190? And if you are, that's a full submission, and you eligible for the £1,000, and you can claim that. Question three was, are any of your contributions higher in any year during the remedy? If so, full submission. Question four is your 22-23 growth higher than 40k? So that's here on the summary page, and if it is, that's a full submission. Question five, again, is one about tapering. And notice HMRC is deliberately asking for figures that are 10k below the actual limits. And they're doing that because they want to very precisely work out whether or not people are subject to the taper or not, because they know that people, and indeed some people's advisors, have got this wrong. For example, with including things like gift aid from the threshold income limit that shouldn't count. Question six is something that really won't apply to very many people at all, and this is if people also have a private pension that they've already accessed. There's something called recycling. That's kind of small detail. So I'm going to take you through my actual form. Okay, so page one is just a bit of bump. Is why are we sending you one? Now, if people follow me on Twitter, they will see that the BSA of today just changed the process for people that haven't received one, who are expecting one. And there's a way that you can, quote, self-identify, close quotes, to the BSA to request a statement. And I'll hopefully share a link to that in the chat. But basically, they're sending to anybody that they think has exceeded the general annual allowance in a year, or they've requested one during the remedy period. Page two, just kind of a bit more general bump, including what's not in here. And what's not in here is your 23-24 pension savings statement, which should be sent separately. And of course, that was also meant to come in October 2024 for non-GPs. And of course, that's not happened. And all the ones that did come out, I had to tell them they were calculated incorrectly. So they're all being recalculated as we speak. So page three contains one of the most useful bits. So there's a table that goes through all of the new amounts, and by new amounts, this means per that red box, they've done that post rollback piece. And they've also got all the old pension, old PIAs as well. So you can compare the new ones to the old ones. Now, I did ask if SPPA would include this in Scotland, and they refused to include the old pension information amounts, which makes it quite difficult for people to work out if any of the amounts have gone up because they're not all there on one piece of paper, which is a bit of a shame. And it's also got your scheme pays, and all of these amounts are split into both of the schemes. So, for example, I'm in the 95 and the 15 scheme. This one has got lots of technical information. There is kind of one important bit here. And so if you look to the 15-16 tax year and you look at the closing value is based on what your pension was in 15-16, and it's 19 times pension. So from that, if you are lucky enough, and I'm not, for this figure to be above 826,087, that meant that your pension was valued £1 million in 15-16, and you could apply for something called IP16. Now, IP16 is a lifetime allowance protection, and again, people might think I'm going mad in talking about the lifetime allowance because it's been abolished, but that affects the amount of tax-free cash that you can get. And there was to be a deadline of April 2025, but we lobbied the government on this because this whole RPSS thing has been a nightmare, and there's still many thousand that haven't been out. So people had no way of knowing. So that's now been extended to 2027. So it is just worth just checking that value. And if it's above that magic number of 826,087 in 1995, then if you just Google IP16, that's something worth applying for. Page 5 is not particularly useful. Okay, and then we're on to the summary page, and this is the kind of the go-to page. So if you download this link here, bit.ly/TG McCloud triage, and then you can very quickly go through the triage process. So as I said, question 1 is, have you paid AA charges? So if you go to this red bit here, straight away, I can see I'm a triage fail because I've paid AA via scheme pays. So that's I don't need to do anything else. I can appoint an accountant and get them to sort it out. And that's exactly what I did. Okay, question 2 is only relevant for GPs, and they'll know whether or not they were subject to annualisation. Then they're going to need to check their tax returns to see if their income was above those limits in any of those years. Question 3 is, are your contributions higher in any year in this blue bit? Okay, so really simple. All you need to do is compare, sorry, sticker's lost its stickiness, is compare these values. You can see for me, I don't fail on this because all of mine go down. So 43 becomes 36, 51 becomes 44, 37 becomes 13. So for me, all of those numbers go down. So I don't fail on that, but it doesn't matter because I've already failed triage because of this bit, which means I need to do the full submission. Number 4, very straightforward, is your 22-23 growth above that magic number of 40k? If it is, that's a triage fail. So for me, that's a triage fail. Question 5 again relates to your income. So you will know whether or not your taxable income was above those levels for 22-23, which is a closed tax year. So you will have already submitted that. And as I said, question 6 is that bit that's not massively relevant. So I will stop sharing, and then Jordan, if you can just reshare the slides, please.
Brilliant. That's you done, isn't it? I think, Tony.
Yeah, so I'll hand over to Kieran. Thanks.
Yeah, ideal. Thanks, Tony. They're all really, really interesting, and hopefully it's given everyone a really good background understanding to annual allowance, lifetime allowance, and obviously your RPSS statement. So obviously part of the reason we're here today is to talk about McCloud in general. But what we wanted to do is share a bit of our process, how we can help you. So, you know, from all of the different bits that Tony has been through, you can see it's pretty complicated, number of years involved, checking if things have gone up or down, maybe having issues accessing information, requesting information, and just generally, being a complicated subject. So essentially what we've done is created a bit of a streamlined end-to-end process. So we can sort of take that administrative burden off you. We know everyone that's going to be listening today, all of the medical profession are exceptionally busy people and need to put their focus elsewhere. So essentially our process is pretty much broken down into 4 stages, and we'll come on to those in a bit. So, but the main part of this really is that, it's medical specialists, we've already covered who we are, what we do, reviewing the data that's been received by you or us, so we can request the data from HMRC and NHS pensions on your behalf. We review that, process the calculations, and obviously we can do the 2 parts of that, which essentially is, reviewing whether you fail the first stage, which Tony's just been through. And again, the tools are out there easily available if you want to do it yourself, but it's having the confidence that you're inputting the right data, you're using the right data that's been given to you. So if you do fail, you then go on to the full process, as Tony said. And essentially what we then do is to complete more detailed calculations, establish whether you've got increased charges, decreased charges, or any changes, which obviously result in refunds or additional payments that may be owed to HMRC. Tony's been through the triage process, and from all of the different cases that we've seen, is you could actually pass triages and you don't need to go to the full submission in terms of the questions that are being asked. But actually, in lots of cases, what we're noticing essentially is that maybe you did have a previous annual allowance charge and it's just never been reported, it's never been disclosed to HMRC. So essentially this process is giving you the opportunity to get comfort in that up to the end of 2023, so the 22-23 tax year, you've fulfilled your obligations. You've done everything that you need to, and you've reported your tax charges properly to HMRC. So, if anyone ever came knocking, looking into your pension and tax information in the future, they may discover those charges that would have been there. They might not have been reported. So essentially, completing the submissions and getting some sort of expert support can help you, tick those boxes and make sure you've got comfort in everything that needs to have been done. So yeah, essentially the process is broken down into 4 stages, as I say, and I'll cover a couple of those in a bit more detail in a second. So, if you did need some help, you've received your RPSS statement either, since the start of October where they first were issued, and you still need, you still haven't actioned it, you still need to do something with it. Or if you're receiving your statement now, which, there are more batches that are being received through February, March, April, and obviously as we continue throughout the year, there'll be more and more statements issued, particularly as Tony said with GPs. So we're already seeing lots of letters going to clients, which, if there are GP clients which say, sorry, we can't process your RPSS because your pension record isn't up to date. And obviously, it's really important that you fill in those gaps, submit those pension certificates and bring up those years up to date. And at that point, then they can generate an RPSS statement. So, we'll go through a couple of stages in a minute, but essentially it's all streamlined. And as Tony's already alluded to, the whole process is essentially free of charge. So we'll raise the fee, which is in line with the compensation that is payable by NHS pensions. So if you can go to the next slide, please. So just looking at the calculation and submission stage. So as Tony's been through the number of years involved, and just looking at the McCloud years, that's excluding the years prior to that and after that, is there are 8 years involved, and the whole process is very time consuming, very long winded, and it's 200 pages of detailed questions which are asking for tax details from all of those years. And as you can see in the bit of the screenshot that we've put on there, they would be asking for things such as taxable pay, personal allowance, any income tax relief that you may have claimed through expenses or other things like that, gift aid contributions, and obviously then interpreting your pension growth. So essentially what HMRC have done is to complete a data table. So you can request that from HMRC, and we could probably put some instructions in the chat or in the follow-up notes afterwards in terms of how you can access or request that, because you will need it. And they've got a bit of a delay, they say 30 days, but can be longer. So it's lots of information to input into the tool. And part of the key bit within this is human error and the knowledge required to complete it. Tony's already commented on, clever people getting things wrong because it is so complicated, including gift aid perhaps when it shouldn't be. And these are all key things that you need to be aware of. So, after the calculations have been completed, so, you want to know if the outcome that the tool would be giving you, does that make sense? And again, it's that professional and specialist support and advice that can give you confidence. So if the outcome is that you're due a refund of £20,000, does that seem reasonable? Sorry, can we just go back to the one before? Does that seem reasonable? Would I expect that? And obviously that's what we'll be doing. We'll be reviewing the data and establishing if that does make sense. And part of it is to provide a report back to you. So on the right hand side of this page there's an extract of a data table within the report. That's an easy way of summarizing all the data, and just looking at this on screen, so you can see just at the bottom of that data table on the right hand side, there may be compensation in the form of an amount paid to you to where you've paid tax charges personally, or compensation via your pension scheme to where you've paid tax charges via scheme pays election. So the NHS pension scheme has picked those up. There'll be compensation back, could be compensation back to the scheme in those situations. And so total compensation is shown there. And as we've said, there can actually be increased charges, particularly for the 22-23 year, whereas we've said we weren't able to report tax charges for that year. And in fact, HMRC requested that you didn't do. They requested that you waited until you've received your McCloud information, your RPSS, to do that. And as you can see, hopefully you can see it, it's big enough, is the combination of refund and charge on this schedule is about £14,000. And what we're finding is if you are due a refund, our average refund is something in the region of £14,000. So, it's tax charges that you've paid previously, and, essentially it's money that you're entitled to. So, it's worth making it clear is everyone isn't due a refund. Some people pay more, some people get refunds, and refunds can be greater or lesser than £14,000. But that's just what we're seeing is all of the cases that we've worked through, pretty much on average is about £14,000 that's coming back to affected people. So if we just go on to the next one, please. So we said about the cost claim back scheme. So obviously when Tony gave his background information as to the age discrimination, it's clear that this has not been the fault of any pension members, and therefore the additional work that's required to calculate the impact of this on you. And if you require professional support, there's some money that can support you with those costs that you need. So £500 for a choice between whether you want your benefits in the 95 or 2008 scheme for the 7 affected years, or in the 2015 scheme. And if you've retired or are retiring, at some point you will be given the option as to whether you want, how you want your benefits paid to you. Is it in the old scheme? Is it in the new scheme? And what does that look like? There is £500 payable to you, for advice that you might be incurring to help you choose those benefits. And then the next one essentially is £1,000 for accountants, where you need to complete the full HMRC digital service. So that's the additional calculations that we've been talking about. And there's also, even for the triage stage, so that's the bit that Tony's just been going through, is there's up to £250, including VAT for that. So again, any of these bits, it's having professional support, someone looking at it, and again, it's free of charge essentially. So just on to the next one, please. And so again, I mentioned a couple of slides ago, the whole end-to-end process, trying to make it as streamlined and straightforward as possible for anyone wanting to use us and having us support them. So our fees, you can see them there, so triage only £240, including VAT. That's within the threshold of compensation, so fully paid, and obviously the full calculations, £1,000, including VAT, again, fully paid. And essentially the way in which this works is we do the work, once it's sent to you, we'll raise an invoice to you. Once you've paid it, we can then help you complete the compensation form and give you the relevant attachments to the claim. And from what we're seeing, NHS pensions through the cost claim back scheme are repaying these amounts to you within 2 to 4 weeks, something like that. Might be less, might be more, just depending on the volume that they've got at that point in time. Next one, please. So just thinking of some deadlines and a bit of additional key information for you. Appreciate it's quite a lot of information to go through. So there are some really key deadlines within this. And there's quite a lot of, I wouldn't say myths, but some information which is concerning quite a lot of people, but it might not actually be as bad as it seems. So the first one really is, Tony's already mentioned it, there was a date set of the 31st of January 2025, where you needed to submit your calculations to HMRC for the McCloud Remedy. And essentially that deadline was if your RPSS statement was issued after or on or after the 1st of November, then you would be due to submit that by 31st of January. For anyone whose statement was issued after the 1st of November, you've got 3 months from that date. And obviously it doesn't take much to work out that we're well past 31st of January. And therefore, we'd be looking back to essentially early February for the 3-month deadline to apply. But actually, from what we're seeing and how we understand it from HMRC, they've not publicly announced it, but we don't believe it's in the spirit of charging interest or penalties on if you miss that 3-month deadline. So you want to be taking action, you want to be doing something with it, not least to see if you do a refund and obviously claim that refund back. But as we believe it is, HMRC wouldn't be looking to enforce interest or penalties on late payments. There is a but, which is the 6th of July 25. So this is a really key date, which is for scheme pays election. So we've already covered that you could have increased charges in some of the years. Obviously, it would only relate to those in-scope years, which are 1920 onwards. Just go back, sorry. Yeah, and if you do have an increased charge from 1920 onwards, and you want to pay that by scheme pays election, we obviously recommend that you seek advice as to which is the best method of payment. But if you did want to pay it by scheme pays election, the deadline currently is set at the 6th of July 25. And it's possible that if that's missed, they may not pay it, or there may be interest charged on any of late payments. And that may not be avoidable. So it's really important that if you're sat on a statement, you do something with it, be that you calculate the impact personally, or you seek some professional advice to get that sorted for you. Separate to that, so Tony's already mentioned the 1920 year was a particular year for compensation. So there was a compensation scheme raised, which essentially any clinicians in England and Wales where they had an annual allowance charge would have had their charge paid for them to be compensated by the NHS. And there's a 6-month deadline from the date of your RPSS for that. So again, not something to be sat on. You really do need to take some action. Otherwise, you could be missing out on free money essentially for that year in question. Tony's already mentioned IP16, so individual protection 16, which relates to the lifetime allowance, and that's just to refer you to, in the middle, there's a bit of information as to what that relates to. And then on the furthest right-hand side, it's just, again, summarising really how much of a project this is. It's a big number, as Tony said, 1 million or so statements, and you can see the various different splits of categories on the right-hand side, and the various dates or deadlines for when NHS pensions have said they're going to issue statements by. And as you can see, July, October, and it's going into it's nearly up to 2026 when we look at those. So it's going to be something that's going to be around for a number of years before it's fully finished. So just on to the next one, please. Just before I hand over to Dan from our financial planning team, who's just going to cover off something called contingent decisions. It's just, if you're interested, if you need some help, please feel free to get in contact. We've got a dedicated web page which you can see there. We'll put links in the chat of how to access that, and obviously follow up afterwards with some more information. And I think I did see a question in the chat which Dan kindly answered, is if you're wondering where your RPSS is and you haven't received one yet, you can now request one. So again, we'll put the details either within the chat or follow-up notes, and you can now request that by completing an online form, and you can do that. And we recommend doing that as soon as possible. It states that it'll be on a first come, first serve basis. So the sooner you get in the queue, hopefully the sooner you might get your RPSS statement. So just on to the next one, and then I'm going to hand over to Dan just to talk about contingent decisions.
Thank you, Kieran. Good evening, everyone. I will keep this short and sweet, given the time. So some really useful information on everything that we've been through there, but one of the things that has been slightly unknown up until the last few weeks is what happens with these decisions that people and members may or may have made. So what is a contingent decision? It's a decision you made or did not make because of the actual or perceived implications of the 2015 scheme reforms. So decisions that people took because of the McCloud ruling, because the McCloud ruling has been proven to be unlawful, those decisions, members are rightly pointing out, would not have been taken had they have not been impacted by the McCloud ruling and the scheme reforms. So, for example, a couple of key kind of examples: members who maybe opted out of the NHS pension scheme, members who reduced their membership because of annual allowance or lifetime allowance implications. So maybe did 6 months in the scheme, 6 months out of the scheme. They're hokey-cokey, as it's referred to there, the common kind of name that people give it. Or those members who maybe, because of primarily annual allowance issues, they cancelled added years contracts or additional pension arrangements in the 1995 or 2008 schemes. So members took a course of action because of the scheme reforms, and with all of their membership now potentially being put back into the legacy schemes, members have asked the question, well, I didn't have any 2015 benefits because I opted out of the scheme, because if I didn't want 2015, I only wanted 1995 benefits, for example. So there's a lot of questions, a lot of things that are coming out of this. And in the last couple of weeks, we've started to see this process evolve and develop, and we're now starting to see an applications go through in terms of what that might look like for members. Another kind of contingent decision covers off choice 2 exercise. Anyone with choice 2, you will be impacted by this as well. However, I expect there to be, given the numbers on today's call, I don't expect anyone to be there. So choice 2, opted out, deliberately reduced membership, added years or potential added pension, additional pension, are those members who are covered by contingent decisions, and that is those who took those decisions between the remedy period of 2015 and 2022. Could move on, next slide, Jordan. So as I pointed out there, you now have the potential to undo those decisions or take a different decision. A lot of what we've been through, what Tony and Kieran have been through there, covers off the digital service and the impact of the RPSS and correcting those annual allowance tax charges, for example. The digital service will only do that based on your current record. It will not do that based on contingent decisions. So you have to make your contingent decisions separate to that process. Once you've made your contingent decision, you will then receive another RPSS and have to go back in and resubmit or submit or amend your previous submission. with each of these, the obvious point is who should be. Ultimately, you have the choice now to buy back membership in the 1995 or the 2008 legacy schemes. Who should be doing that? Well, there's a question of shouldn't everybody buy back the membership? Shouldn't everyone fill in their gaps? Shouldn't everyone fill in the records? But obviously, there are costs to do that. You have to pay the contributions for it. And for some people, that might be possible. For some people, that might completely rule them out. So there is some intricacies in this of understanding what are the benefits of actually doing this. There is a cost and there is a benefit, and you need to understand what the cost benefit is. The key, it does create a number of potential planning opportunities, as it states there. So for members, for example, who opted out the scheme, and in particular, kind of if we look at consultant side first, you might have people who have gone through big pay increases since they've been opted out and they want to revise their final pensionable pay and take a significantly higher pensionable pay number into retirement rather than the one that they had when they opted out. Now that will have revalued, so you need to kind of understand the intricacies of that. And of course, you might have annual allowance issues if you're trying to almost create this large increase in your pension benefits. So you need to understand the relevant tax charges that will come with that and understand the net benefit and the actual takeaway that you will get. There's also going to be people who have potential, in particular on the practitioner side, people who have opted out for a full period or gone through that period of having 5 years out of the scheme and ultimately delinked their pension. They could go back in and reinstate things like dynamisation, which is an additional 1.5% increase on your pension benefits over and above CPI. Those particular members might well look and say, well, I can get some really good increases out of here and I can really manage costs. There's a lot of kind of intricacies in this, and understanding the benefit versus the cost is going to be key, because there are, NHS BSA have created some calculators on their website. And the calculators on the website allow you to go in, put in what your earnings were in the year, what your other taxable income was, if you had some rent, bank interest, other things like that. Put in your your income position for the year, your pensionable pay position for the year, and work out the costs of buying back either 1 month, anywhere up to the full 12 months for that year. Now, you can do that for any 1 month in the whole period of the remedy period. So you have a bit of an open book in terms of what you buy back. Do you buy all of it? Do you buy 1 month somewhere out of the 7? And if so, which one of the 7 years do you actually buy back? Questions to understand there and to maximize what your pension looks like in terms of cost benefit again. So one of the key things in the calculators is understanding that the calculators that you have, there's a separate one for consultants or officers, there's a separate one for practitioners. And what you have is for every role, so maybe you have 2 salaried role, an officer with 2 postings, or a GP who has some hospital work as well. You may well have to do, you have to do a separate form per role that you have. So you could end up filling in 4 or 5 of these and submitting these forms. What you do is you fill in the form, it gives you back a net cost, and it takes into account your tax position in that year and the tax relief that you will be given, and it gives you a net cost. So in buying back the actual membership, your tax relief is kind of automatically implied with the costs that you have to pay the NHS pensions. When you fill that form in, you send it off, NHS pensions will then come back and give you a quote. Now, the quotes are only going to be based on the information that you put in. So as I say, you need to understand, well, what information am I putting in? Do you send it off and say, right, well, I've been out the scheme for 7 years. I came out in 2015. I want the full 7 years buying back. Here's all of my income. Give me a quote for the full thing. And NHS pensions will come back and give you the quote according to that. You might try and be clever with what you're doing and find the right gaps. That's your prerogative. I would say I think NHS pensions will probably be mindful of how many quotes you are requesting, because they will expect you to be looking at the quotes that you are actually going to proceed with. I don't think they'll be wanting, and obviously the process will be slowed down significantly if people are ultimately trying to send in many different ones and get many different results back. But you will submit that quote. NHS Pensions will then come back and say, this is what your costs are. This is the impact on your benefits. And you then have the right to actually go and buy that, pay the money to NHS Pensions, and they will update your records. They will then send you a new RPSS with the annual allowance position rectified again. And you will use that. You'll go through the digital service again. And obviously you will have paid the money to the NHS Pensions for that membership. The key things that you have to understand within there, the actual cost of those benefits and how you actually do those. So I've used the tool earlier today to run a couple of different examples, and these are just to give a demonstration of the different numbers. For a GP for a practitioner looking at buying back the 1920 tax year in full with profits of 150,000, it costs 24,000, circa 24,000. For a consultant or an officer buying back 2019-20 tax year on 150,000, it costs 14.5. So an officer buying back that year costs 14.5. A practitioner buying back that year costs just over 24,000. The reason being, as a practitioner, you're having to pay the employer costs as well, because obviously the superann costs that you weren't paying through the partnership have gone into your profit figures, and you've actually had a benefit from there. Now, as an officer, there is a question of, have you recycled your contributions? If you say yes, they will adjust the contribution rates, and I think we were discussing this earlier, Tony. It's not a kind of exact science, and we're still not quite sure how they are working. I think it's very vague at the moment. The calculator will adjust things, but there's no definitive answer on who's covering those employer costs for officers. Practitioners look like they are in there. It also adds on interest. So the further back you go, the more interest you will pay. Do you buy a more recent year? Do you buy a further back year? Do you cover all of them again? And obviously, when you're looking at this, you're filling in a spreadsheet and sending off a quote and saying, okay, well, the spreadsheet's kicked out for an officer, £14,500 of costs. Do I have £14,500 first and foremost? Yes. Okay, right. Well, I can put that towards the scheme. What am I getting from there? And that's what the quote will come back and give you. As I say, for certain people in here and certain members, there's going to be a key game to be played, if you will, in terms of how do you get the most benefit. Because if you look at buying the full 7 years and that is unaffordable, you then want to look at how do you maximize what is affordable to give you the maximum benefit. A couple of other questions that have come up. Compensation scheme. We said we might not cover it, but I'll touch on it. We don't know anything on this as it stands. NHS Pensions, NHS BSA, NHS Pensions have not confirmed. We know that financial advice for contingent decisions is within the realm of what is covered. SPPA have come out and said, I think you said again, Tony, £500 is what SPPA would cover for contingent decisions, financial advice. So it could well be similar, and that might be something that doesn't seem to stretch very far given the complexity of the area that the people are seeking advice on here. It is something that is really, really complicated, and it is something that for people with big gaps with big gaps in service or with big uplifts, I would encourage you to kind of consider getting some advice in that field, because just running the quotes might, for a kind of full 7 year, might well look considerably expensive. However, there is some significant benefits that you can be had on your retirement benefits by getting this right. So I would encourage you to kind of consider just going about looking at your records and trying to be smart with this and getting the right advice in this field, because some of these decisions can be very, very complex and have a lot of knock-on effects. Can you move on there, John? I'll hand it back over to you now, Kieran, for any questions.
Yeah, brilliant. Thanks, Dan. That's really useful to know. Obviously, it's difficult decisions, and obviously, especially with any sorts of financial advice, it's really useful to get, someone who knows what they're doing. Just have a look at it, run the numbers, see if it's worth your while. As we say, it's a relatively new thing. There's lots of unknowns as yet, and obviously more and more guidance and more knowledge will come out in the coming months. Appreciate we've just gone over time slightly. If anyone's got any questions, please feel free to post them in the chat. We've had a couple in there. I'll just, if anyone's got any questions, put them in there, but I'll just run through any of the ones that we've got. So some of the main ones, really important ones are, when should I expect to get my pension RPSS? It's overdue. Dan kindly answered this one, and it was just using this self-identify form, which again will send details of that, so you can request one if you think you are due one. But essentially, it should be, most people should have got them by 1st of September 2025. And obviously lots of different categories of people should get them sooner. But if you wanted to speed things up, use the link. Couple of comments about HMRC data is taking a long time. Yeah, as we said, ideally 30 days. It can be more or less. Sometimes we've had to chase. If anyone's waiting on anything, it's best just to get in contact, chase them again, and hopefully someone will get back to you as soon as they can. Someone else asked, how confident can we be in the figures in the statement? Yeah, hopefully reasonably confident, but we have seen lots of different statements with errors. I mean, it's probably quite easy to say, but errors should be relatively visible. If you've got, if your pension growth's relatively static, it massively spikes. Your earnings haven't particularly changed, that could be an issue. Certainly know Tony and I have spoken about whole-time and part-time working and the issues and things that could create. So NHS pensions, hopefully should have reissued statements. We've had a few clients that have had 3 RPSSs, through different changes that have been made. But essentially, it's looking at the underlying data and seeing if that generally makes sense, and if it doesn't make sense, it can be looked into a bit further. Last, bit of a technical question, might be one for Dan or Tony. I haven't received an RPSS and I took partial retirement in March 24. How does this affect my position? I've had to pay AA charges, some direct to HMRC and some to scheme pays.
Yeah, so you're still eligible for McCloud, and the way that the scheme want to do it is to give you your RSS, and that's that table that Kieran had at the end of his slides that showed that they're really very delayed, to allow people to make their McCloud choice, and then they can kind of issue a final statement. But you are still eligible to make a McCloud choice, and you'll still be choosing whether or not that 7-year period is going to be in the new scheme or the old scheme. And depending on the age you retired, it's not at all a foregone conclusion. I think everyone assumes automatically that you're definitely going to be better off taking off legacy benefits, but depending on the age of retirement, it can look quite different in the different schemes. There was just one other question I'll comment on. So Ken asked, is there a possibility of the government dropping the AA tapering penalties? I mean, I think the chance of anything happening retrospectively is 0. That's not going to happen. But I did meet with BMA Pensions colleagues. I met the Minister for Pensions last Wednesday, and this was probably the thing that we spent the longest discussing. So BMA surveyed around 5,000 consultants and GPs, or we had 5,000 responses, and the taper is clearly still a very significant problem for lots of consultants and GPs, and it's something that we definitely have the Minister's ear on. I think he understands better than he did that it is still an active problem, and that's kind of delaying the ability for the government to sort out waiting lists if people are held back, if they're affected by the tapering. And obviously not everyone is at the new high level, but it's something that they're more aware of than they were before the meeting. And we will continue to apply pressure. I mean, as I said, when we kind of discussed the taper in the slides, it's just a really badly designed tax. So people can increase their income by £1 and find, if they've got high pension growth in that year, that their pension tax charge increases by £22,500. So how anyone could be in a position where £1 of income can increase your tax by £22,500 just shows that it's a really stupid and badly designed tax. But there's lots of problems in the tax system, and the government have inherited a number of problems, and it's on their list of things to look at. So watch this space, but I don't think anyone's going to be wiping out anything historical. I think you can safely forget that.
Yeah, I mean, that's really interesting, Tony. It's obviously just thinking of our GP partner clients is, you run a business, you make a profit, or hopefully make a profit, and those profits vary year on year. You don't have an awful lot of control over those profits, other than you want to maximize them or increase them. You could be making decisions and come along, your accountants come along at the meeting and say your income's over 200,000 or whatever it might be. Obviously after deducting pension contributions, you couldn't have known how to plan for that, because you don't necessarily know what the profits are going to be for that year. So it's really, really difficult, isn't it? And obviously, I guess as consultants, you don't know what your pay rise effectively is going to be, because it's not yet been announced. You're a month or so overdue in terms of when your pay rise is going to be announced. Again, it makes planning very, very difficult, doesn't it? Because you could just get lumped with, yes, might get a good pay rise, but you can't necessarily control it because it's a couple of months have gone by. There was a couple of questions left, which was I think we've already answered one of them in essence, which was helpful to know if having taken partial retirement impacts on RPSS. Tony went through that, and it looks like Dan is typing back to Andrew about opting out of the pension scheme, and should he apply for RPSS and compensation. Do you want to say that one out loud, if that's all right, Dan?
Yeah, I was just going to give the classic financial advisor answer of it would depend on your circumstances, Andrew. Which probably everyone would expect. But genuinely, you might want to consider reinstating those years, or some of those years at the least. In particular, you've got 1920, which should still qualify for the compensation scheme. So you might well want to consider reinstating some of that. One of the, I guess, key perks of that is that when you do reinstate service, you can look at spreading the cost of what you reinstate over a number of years through your NHS pension. I spread the cost out over spread the cost of buying back that service over the kind of upcoming years from what the scheme is paying you anyway, and try and take the net benefit from it. So it might not kind of cost, and I say that with big kind of asterisks around it, might not cost you an upfront lump sum in the usual way. It might be that it's kind of just taken from the scheme direct, and you just increase your pension accordingly. So there's some quite clever ways of doing that for members who have since retired but want to reinstate some service.
Just to add on Andrew's question, so Andrew came out for 3 years from 18 to 21. And so that kind of comes back to this whole in scope and out of scope thing that I talked about before. So if those 3 years, 18, 19 is out of scope, so you can buy back all of that year, and if there's an increased tax charge, that will be thrown in the bin because that's out of scope. So there's no tax charge there. Assuming that member was a clinician in England or Wales, the 1920 tax charge again will be in the bin because that's covered by the compensation scheme. So you could restore 3 years of pension and then just essentially pay tax on the 20/21 tax year. So if that 1 year out of 3, but as Dan says, all of this kind of needs to go into the melting pot of kind of cost versus benefit, because as a deferred member, you will have got you know, an increase based on your final salary for when you came out, then that would have been inflation uplifted, versus by restoring it, and then that will restore that final salary link to take you up to the end. So, you know, the complexity of the calculations is enormous to try and work out your different positions. And worth pointing out as well, you don't have to restore all of it. So, you know, for example, you could just restore the bit that's out of scope and the bit that's covered by the compensation scheme. So you could do 2 out of those 3 years. You could do 18-19 and 19-20, which would cover the AA tax. But all of that needs carefully kind of calculating and offsetting in how the final salary linking is going to change your position. So it's really complex maths, and there's no way that that can be done for the sorts of money that SPPA have suggested, or the source of money that you know, they're suggesting for compensation. But in terms of getting to the right answer, that could make a really big difference to your retirement benefits. You know, those 3 additional years are going to be three more years. You know, so even if you've not got added years, that's another 3/80ths towards your salary. You know, and if you retired at 60, the actuarial data for the scheme is that most doctors live between, you know, 88 and 90. So you've got a 30-year retirement. So any increase to your pension times 30 years is worth a lot of money. But it's about doing all of the sums and working out what's best for you in your individual circumstances.
And just to point out for those on the call who aren't aware, that is, we have all of those tools available in Forvis Mazars on the financial planning side, and that is something that we do kind of on a regular basis for members. That the complexity of those calculations is something that we can get our head stuck into and give you the right advice and the right numbers in those spaces, because many of you will be clients of our accounting side, and some of you I know are clients of the financial planning side. But for those who don't know where to look for those kind of complex answers, we are available to give us a call, and we can support.
Yeah, and that's sort of prospectively as well as retrospectively, isn't it, Dan? You know, in terms of future, you know, looking at decisions and things and how that impacts you on the future. So lots of different things that we can help with. So yeah, you know, just appreciate time's getting on a bit now. So we just want to, you know, thank you all for attending. Thanks for Tony for helping us out, you know, going through and sharing some of his knowledge. Thanks to Dan for a bit about contingent decisions. As I say, you know, we'll follow up as soon as we can with some of the key links and information we've talked about. Really hope it's been useful for you. If you've got any questions, you know, details will be shared. Really happy to help and answer where we can. So yeah, thanks everyone. Hope it's been useful, and speak to you again soon.
Cheers all.